Hello, and welcome to Strategic Investment Group's latest FocusPoint webinar titled 2016's Investment Outlook, Navigating Economic Uncertainty and Financial Market Headwinds. One of our goals is to make this webinar as useful as possible to our listeners. So if you have a question at any point during the presentation, please type it into the Q&A box on the lower right corner of your screen, and Marcus and David will answer it once they've finished with their prepared remarks. My name is Jameen Yu, and I would like to introduce our speakers, Marcus Criguier and David Ordabadi. Marcus is a Co-Chief Investment Officer here at Strategic, focusing on our economic and investment strategy outlook. And David is a Managing Director and Economic Counselor, one of the heads of our relationship management team, as well as a contributor to our investment teams and economic research. They put together a very timely presentation for you today on what the landscape may look like for 2016. So, without further ado, please take it away, David.
Thanks very much, Jameen. Well, Marcus, this is certainly an interesting time to review markets. The new year has not started well. U.S. equity markets are down about 6%. European and Japanese markets are both down about 10% in dollar terms. Chinese equities have fallen 17%. If you look at bonds, sovereign bonds issued by core euro area members, Japan, a number of Scandinavian countries, as well as Switzerland, carry negative yields well out the maturity spectrum. And yields on U.S. Treasuries, although positive, remain exceptionally low. After plunging last year, oil prices have continued to slide, and Brent crude is down about 10% so far this year. We've been concerned, and our clients have been concerned rightly about these developments and want to understand the underlying factors driving recent market movements. So over the next half hour, I hope you'll assess for us the major market drivers, analyze short-term prospects for global markets, and set out our tactical positioning in light of these developments. Without wishing to give away the punchline, a key message I think you'll find of Marcus's presentation is that the fundamentals are not as fragile as markets suggest. So Marcus, let's start with your assessment of the factors underlying widespread investor angst.
Absolutely. Thanks a lot, David, for the introduction. Indeed, financial markets did take a very grim view of the current environment, and I think it will be useful to have a closer look at the factors that are behind this considerable pessimism. But let me start with a general observation. It appears that many investors are still looking at the world through the lens of past crises. In other words, they're trying to identify factors that might drive us again into some form of systemic or coordinated economic and financial crisis. And I think it will be interesting to see whether there's anything out there that might substantiate or contradict that view of the world. So let's have a look at slide number 3 that is currently up, which is meant to capture some of the key drivers that have, what at least as we think, given rise to the anticipation or the fear that we might be on the verge of another global economic or financial crisis. Now, quickly running through those factors, there is some angst that Fed policy might contribute to another crisis. As a matter of fact, there are concerns at the moment that the U.S. is heading into recession. And if it's not the U.S. recession, it might be China that might produce a hard landing of its economy, which in turn then would have systemic knock-on effects. If you talk about China, you very quickly talk about the entire emerging market universe, and there are certainly also some concerns about a more coordinated and systemic emerging market crisis, and we will have a very quick look at that. And then, of course, there are oil prices. David already alluded to the fall in oil prices, and maybe more generally to a somewhat confusing and in some ways chaotic situation in oil markets. There are undoubtedly some concerns that oil is signaling something that is much more grave and severe than might probably meet the eye. And again, we'll have a quick look at that. And finally, there has been talk about the risks of a credit crisis, particularly triggered by developments in energy markets and the knock-on effects of corporates that are operating in those markets. Now let's start out with our first factor, which is the Fed. And the question here is, did the Fed contribute or cause, or is in the process of causing market turmoil, maybe related to what some would call a policy failure? Now, if you have a look at that chart, for those of you who listened to an earlier webinar last year, you might recognize this chart. This was a chart that we put together to make the point that the first rate hike by the Fed historically has not created damage to most asset markets across the globe. And that is shown on the left-hand side in the short term, so that is the first month after that initial hike. The middle section, the middle group of those bars represents the asset market response to an initial Fed rate hike 1 year after that rate hike. And then on the right-hand side, we added the development in asset markets since December of last year when the Fed hiked rates. And you can see there that there's a pattern that does not fit or that doesn't correspond to those historical patterns. So the question here is, what happened there? What went wrong? And of course, the first explanation that springs to mind is that there is concern in markets that this time around the Fed might be producing a worse economic outcome than in those previous episodes, which might then justify sell-off across those markets. So why don't we just have a look at the U.S. and how the responses might have played out or might be playing out in the months to come. Now, I want to address a perception that might be related to that pessimism before we have a look at actual data, and that is a perception that the longer an expansion lasts, the more likely it is that you will experience a recession. And I'm actually referring to a situation that you might compare to something like cyclical gravity. In other words, if you go up for a long time, at some point the business cycle will develop mechanisms that will ultimately produce its own demise and will lead from expansion to contraction. And on that chart, you can see that if you were to follow that logic, that the current expansion since 2009 is actually now definitely among the longer expansions, at least in the post-war period. Now, the Fed in San Francisco has actually added some interesting insights to answering the question of whether that is really a worry worth having. And if we switch to the next slide, you see the summary of some work that they have done, borrowing from a branch of statistics that's called survival analysis. And basically what the study has examined is whether there is a relationship between the duration of an expansion and the probability of that expansion coming to an end. And you can see in that chart a pre-war and a post-war result. I'm referring to business cycles pre and post-war. And those results can be summarized as saying that, well, admittedly, before or in the pre-war period, there was a relationship. The longer the expansion lasts, the more likely it is going to end. However, in the post-war period, we have not seen a relationship between the duration of an expansion and the likelihood of it coming to an end. And that would, in our view, give a fairly important answer, namely that the duration of the current expansion does not signal that we should prepare for the demise of the expansion and a slide into recession. Now, if there is no regularity or if there is no reason to interpret the current duration or the long duration of the expansion as a sign that a recession is coming, well, maybe there is something in the current data that signals trouble for the U.S. economy. So let's have a look at the next chart to examine or to look at a very interesting summary of the recent data set that is describing the U.S. economy. And we're actually doing that with the help of a chart or with the help of a model that has been created by the Federal Reserve Bank of Atlanta. And they have created an interesting model, a so-called nowcasting model, where they take a large amount of data that describes the U.S. economy and extract the growth factor in the GDP growth in a very timely fashion. Usually GDP growth is a very lagged data point that usually tells us what happened in the past. Now the Fed at Atlanta has created that model to get a better read on where the economy is at this moment in time. And as you can see, the growth rate that is plotted on this chart and that has evolved, the estimate of the growth rate for the first quarter that has evolved since the beginning of February, actually tells us that the U.S. economy is doing very well. At the moment, the model pegs U.S. growth at real growth at approximately 2.6%. And if you keep in mind that most estimates of trend growth in the U.S. at the moment are anywhere between 2 and 2.25%, then I think it's fair to say the U.S. economy is doing quite well. So with that in mind, we would probably dismiss that second concern as well, the second concern that a U.S. recession is likely on the horizon. So let's move on to China. And before we make a few comments on China, let me just share this quote with you that's up on the chart, which I found very interesting. There has been a lot of shouting and screaming about what is going on in China, a lot of different views, concerns, fears, economic fears, fears related to the debt situation in China, and everyone seems to have very strong views. I agree with the gentleman whose quote is shown on the chart that there is a lot of uncertainty of what's going on in China, and I think we need to be humble when we arrive at results and when we conduct our analysis. So please remember that disclaimer when we go through the charts, but also as we go through time, and you probably remember the results that we will develop in a few minutes. Now, on the next slide, you have a backdrop for a few comments on the growth situation in China. Now, at the moment, most reports that come out of China would suggest that growth is in the vicinity of 6.5%. That's real GDP growth in the vicinity of 6.5%. And we have tried to do as much background work as possible to understand whether that is a good economic figure. And we have concluded that growth in the vicinity of 6.5% is indeed a fair description of the Chinese economic growth pace. And in other words, we are not buying into the fact or the view that the Chinese economy is already landing very hardly, which probably would be best described with a growth rate between anywhere 3–4% or even below that. So it appears that the Chinese economy, while slowing considerably from the growth path that we saw 3, 4, and 5 years ago, that we are somewhere in the vicinity of 6.5%, which would qualify as a continuation of that gradual decline in GDP growth, which we believe has been engineered by policymakers. In other words, which is a side product or a consequence of the rebalancing that Chinese policymakers are trying to accomplish, rebalancing the Chinese economy from an economy that relies mainly on heavy investment-driven industrial growth, switching over to an economy that is relying more on the services sector to produce economic growth. Now, while this, as already mentioned, will also result in a slowdown, in a gradual slowdown, however, this does not yet signal that there is actually a steep drop in growth playing out in front of our eyes. And just to refer to the chart for 1 second, the chart is up there to show you that there is indeed some rebalancing happening as we speak. even though, admittedly, that rebalancing is relatively modest, and it's fair to say that it's probably in the very, very early stages and is likely to continue as we move through time. Now, while we're not concerned about, at least for the time being, about the growth path in China, we do watch another factor very carefully, and that is the evolution of Chinese foreign exchange reserves. And here we have to ultimately answer the question of whether the reserve mountain that China has been building up over the past decade is indeed, as we called it, a fortress that will insulate China from potential problems, or whether it is in the process of becoming an Achilles heel of the Chinese economy, an Achilles heel because those reserves have been falling quite strongly or quite markedly over the past couple of months, actually to be more precise, since the devaluation of the Chinese currency last summer. Now, we feel, by having tried to turn a lot of stones in order to come up with a solid answer, we feel that there is still a lot of uncertainty about the underlying causes of that decline in foreign exchange reserves. There's some evidence that Chinese corporates are reducing their exposure to foreign exchange denominated debt by repaying that debt and therefore contributing to a drawdown in reserves. There is some concern, undoubtedly, about Chinese investors trying to channel their savings or their investments outside the country. In other words, there is some evidence that there might be capital flight playing out. However, as I said in the opening remarks to this slide, the dimension of those underlying factors are still to be confirmed. So this is definitely something that is very important to keep an eye on.
Yeah, this chart is quite impressive, and it's quite a mountain of reserves, and the decline from the peak is quite steep. They still appear ample, certainly by international standards compared cross-country. At what point, or what set of circumstances would make you concerned, Marcus, about the decline in a further loss of Chinese reserves?
Yeah, I mean, this goes back to what is actually driving those declines, and this is a very, very important question. I think to put it in a nutshell, if we were to conclude that the decline that we see on that chart has been largely caused by a loss of confidence, in other words, if capital flight were the key driver of that drop in reserves, then that would be something to be concerned about, because we do know that there are, well, at least as we understand the setup of Chinese financial markets and the capital account, that the capital account is still relatively close. So if there is capital flight, then we would have to be concerned that the combination of loss in confidence and the lack of ability to control those flights might actually start to trigger a dynamic of its own, and we might therefore be heading into a situation that might put at some point pressure on the Chinese currency. Now, as I just said, we definitely keep that issue on our radar screen, and we'll monitor carefully all incoming information. We are also monitoring the potential spillovers from a slowdown in China to other emerging economies, and there has been a lot of again, concern and to some extent fears that the slowdown in China might automatically result in a systemic decline in growth rates across emerging countries, and as a matter of fact also might have knock-on effects on developed market growth. Now, the chart that we have up there at the moment is meant to highlight 2 points. Point number one, the exposure, the export exposure to China by several of these emerging economies and as well as the developed market economies is actually smaller than one might have guessed or one might have thought at the outset. So the export exposure seems to be quote unquote controllable or manageable. What is equally important, however, is that this exposure is very heterogeneous. We have some economies at the left tail of this chart that are hardly exposed to China and to China growth path, and then of course we have some, not surprisingly, some of the larger commodities exporters that are very exposed to China. So the conclusion here is, while it is definitely a problem for some economies if China were to slow down further, it is more difficult to generalize across the entire group of emerging economies, which, by the way, is something that we have incorporated in our discussion increasingly over the past couple of quarters. We believe that it is not that obvious or that clear that emerging markets are a homogeneous group of countries and that emerging market assets are a homogeneous asset class. So this is something that we should keep in mind.
I think, Marcus, this chart really does bring out the heterogeneous nature of the emerging market universe. I wonder, though, are there broader concerns in emerging markets and their fragility, including their position late in the credit cycle? Where do you see vulnerabilities in emerging markets if external financing conditions tighten as the Fed raises rates and the external environment for borrowing, after quite a lot of foreign borrowing by emerging markets, begins to dry up?
Yeah, no, this is a good point. There's definitely not just the real side, if you want, but there is the capital flow side that plays a role. And a lot of emerging economies have built up their debt over the past interest rate cycle, and particularly during the time where global central banks have helped to ease financing conditions globally. And we do see that debt to GDP levels for the group of countries as a whole have increased sharply, and for some economies in particular. What is also in this, of course, related and important is that the cost of servicing that debt have increased because some of those economies and you know, just to name one example, Brazil have seen a relatively significant increase in the risk premium they have to pay for the debt that they're issuing. So that is something definitely to keep an eye on. But again, we would stress that there are differences between individual countries within that group. There are countries that are more affected by this increase by this increased exposure to global capital flows, and there are other economies that we believe will be easier to handle potential pressures. But it is definitely something to keep an eye on as we go forward. Now that brings us already very, very, very close to a quick look at commodities markets. And one of the key stories that has taken on more importance and has gotten more airtime over the past several weeks has been the perception that the decline, the collapse in oil prices might be signaling something very sinister that is beginning to unfold in the global economy. And we have, of course, again, revisited our analysis, and we continue to conclude that rather than reflecting a collapse in global demand, global economic demand that then plays itself out in commodities markets, that we are still seeing a significant structural change particularly in oil markets, playing out in front of our eyes. So it is a supply story rather than a signal, that the global economy is breaking away or is falling apart. And the chart that you see up on your screen shows that structural change that has taken place over the past couple of years. It shows the very significant expansion increase in oil production in the U.S. That was the big story in oil markets over the past couple of years. It has not only increased, of course, the overall supply, which then led to a decline in oil prices, it has also meant that OPEC has lost some of its ability to control oil prices and to catch a falling price, as it might have done in previous episodes where oil prices dropped. So the takeaway with respect to our initial question, is there another crisis brewing from the oil picture or from the explanation, is rather than reflecting trouble in the global economy, this is a story that is driven by a supply shock, and we should not forget that lower oil prices in this context are actually good news for everyone who is not an oil producer or who is not dependent on oil prices to generate profit. So this is definitely a story with upside and downside, and it is not necessarily something, a factor that would corroborate a very grim take on the current outlook. Now, on the next slide, we are concluding our quick run through those factors with a look at the what has by some been called the credit crisis in the making, and it is a look at the risk premium, the spreads in credit markets in the U.S. And you can see that for corporations corporations that issue debt in the high yield market, spreads have increased, the risk premium has increased, but that this increase in risk premium is mainly focused on on corporations in the energy sector. There has been some spillover, but the spillover has not been very widespread.
So far, Marcus, you've made a strong case that the fundamentals are stronger than the market suggests. But where do you see vulnerabilities?
Vulnerabilities, and this is actually an interesting sort of transition to the next slide. Vulnerabilities are probably largely in areas that are not at the center of the radar screen of most investors at the moment. Now, some of them are, but some of them are not. Now, we are talking a lot, and I'm starting on the slide that you have on your screen. I'm starting at approximately 11 o'clock on that slide with the oil price rebound. The oil price rebound is related to, first of all, the conviction in the market that oil prices, or the perception that oil prices have hardly anywhere to go but down. Now, I do believe, and this is something that we incorporate in our analysis, that there is a possibility for oil prices to rebound. We have seen a little bit of a recovery over the past week or two, but we also find increasingly analysis, macro and micro, that talks about rebalancing in oil markets. Now, if oil prices were to rebound, we believe that this would change a lot in many scenarios that have to be built into or that are part of investment strategies. And one of the very important factors here would be, and now we're moving to the right in clockwise, would be a pickup in inflation. Pickup in inflation is something that appears or that appears in hardly any scenarios that we're encountering, and I will show you in a minute. I'll show you some evidence that would suggest that higher oil prices might actually trigger a very significant surprise for a lot of investors. So a pickup in inflation is something that we believe is a potential risk to keep in mind. There could be positive growth surprises. Everybody appears to be looking for reasons for a recession. Well, these are the moments where you might actually get blindsided by positive growth surprises, for example, as a result of lower oil prices and stimulus to consumption growth. Geopolitical turmoil, that's something that you will remember. We always mention that. It's very difficult for us to make a clear-cut call on how different geopolitical scenarios will play out. One observation is that most geopolitical episodes or crises tend to stay local. They are not turning into factors that will create global dislocations, be it economic or be it financial in nature. We do like to hint at Brexit, which is, of course, the risk of Great Britain exiting the European Union. We will have a referendum in the UK in June, and we believe that the implications for the UK, but also for Europe, could be significant. It is something that we definitely have to increasingly put onto our radar screens, because there could be some dislocations as a result of that. And finally, at the point we already discussed, the risk of a Chinese FX crisis if we saw that loss in confidence that David and I alluded to a few minutes ago. On the next slide, you have a quick illustration of that link between oil prices and inflation expectations. Inflation expectations have dropped over the past year and a half, largely due to the decline in oil prices. If we saw a rebound in oil prices, we will have to adjust our inflation expectations, which in turn is likely to feed back into bonds.
I think you've given us a very balanced view of why the fundamentals appear stronger than the markets might suggest, but also pointing out some vulnerabilities. How does this all add up to outlook and strategy, tactical positioning?
On the next slide, we just try to give the key messages. We believe that going forward, we have to continue to focus on valuations. This is one of our key ingredients that we utilize to build asset allocations. And here, of course, strong focus on what we believe are expensive valuations in bond markets and a more neutral picture in equity markets. We have to focus on policy support. We are still in a world where central banks do play a very important role in determining the outlook for risky assets in particular. So we will keep a very close eye on incorporating our expectations for Fed, ECB, and Bank of Japan policies, but also the PBOC in China. We focus on portfolio construction. At the moment, we are building portfolios that do not deviate very strongly in risk terms from our benchmark, from our strategic asset allocation, because we do acknowledge that there are some uncertainties out there. And of course, as we just alluded to, we are watching for surprises. Now, just to close out the presentation with just some comments on valuations. On this slide, you have a quick look at yield levels across the globe. And what you see here is this very remarkable shift in bond markets, in government bond markets, towards a negative yield world, if you want, towards a situation where entire yield curves have fallen below zero. You look at the German yield curve, just to refer to that chart, which at the moment delivers negative yields out to an 8-year maturity. And in Japan, it's all the way out to a 9-year government bond. At the same time, you have varying pictures across Europe. The US and the UK stand out, but of course also have very low bond yields. Now, this is a combination of central bank policies, very low central bank rates, and the search for safe haven that has been playing out in several markets. And if we want to round this remark out, if you go to the next slide, let's not forget potential risks that could emerge if markets reprice. We have the good old dot plot up on the screen that shows you the difference between the projected interest rates by the Fed, that's the upper blue line, and what markets are expecting. It's a huge gap. The gap at some point will have to close. If the gap closes by markets approaching what is priced by the Fed, that of course will require a very significant repricing of bonds and fixed income instruments across the curve. And if it rebalances in the other direction, if the gap closes, then of course that would be very supportive for fixed income. We believe it is more likely that markets will approach the Fed projection as we move forward. And let me close out with a quick look at valuations in risky assets. You can see on the left-hand side our equity price to fair value chart that uses our own metrics to derive valuation signals. And you can see that while markets have gotten a lot cheaper as a result of the sell-off in equity markets, we are still relatively close to fair value in the U.S., in Japan. There is value in emerging markets, but of course that corresponds to some of the problems that we alluded to earlier. And there is value in Europe, which is represented in our asset allocation at the moment. And on the right-hand side, you can see that there is value emerging in high-yield bond markets. You can see that spreads, high-yield spreads in the U.S. now are one standard deviation above fair value, which is beginning to look quite interesting. And on the last slide, you have a quick summary of our asset class views. You see that we remain positive on equities, mainly through Europe. Via exposure to Europe. We believe hedge funds are useful ingredient in an asset allocation to create a robust portfolio. We remain negative on fixed income markets, and we still see no reason to move away from an underweight on real assets, even though we have closed our underweight on commodities at the end of last year. And I think we're now ready to move to some questions.
Thank you, Marcus and David. With that, we're going to kick off the Q&A session. As a reminder, please type your questions into the Q&A box on the lower right-hand corner of your screen. We actually had a couple questions come in through your prepared remarks. David, if you'll take that away as well.
Good. Thanks, Jameen, and thanks, Marcus, for that very much. We've gotten a number of questions, and we'll go through them. I thought I would start off with a question that arose on liquidity, which is a vulnerability that we didn't raise, and I think it's a fair point to raise it. A lot of commentators have been concerned about the withdrawal from market making of a lot of previous market makers, banks, et cetera, in part because of regulation, in part because of a generalized retrenchment. And a number of other analysts have looked at the problems of exchange-traded funds whose underlying securities are very much less liquid than the ETF that's being traded. I was wondering if you could comment on how you see the structural risks and then liquidity risks, and how that might amplify price movements in the case of a sell-off.
Right. This is something that has been discussed, and rightly so, now for quite a while, and has been the subject of a lot of analyses by the IMF, by industry organizations, and in the market. And we completely subscribe to the view that structurally a lot has changed in corporate bond markets. And that has already started right after the crisis in 2008 and 2009, with the reduced role that banks have in that market, with the reduced role that banks have as market makers. That has indeed reduced liquidity and has created a situation where short-term variability, short-term volatility in that market can be significantly exacerbated, particularly in periods of stress. Now, what that would suggest is that that market has become a lot more treacherous, particularly if you have a short-term focus, if you try to play that market with very short-term oriented strategies. We believe, and particularly as a long-term investor, that this does not take away from the attractiveness of high yield of credit markets, including high yield markets, and we continue to like high yield markets because we believe this is where we can actually find value. It has been a steady source of alpha of our asset allocation, and we do think that this will stay the case, but we do see that risks have increased, but particularly for short-term oriented investors.
We have another question, changing the topic considerably, but this is a question from someone who's clearly a close student of the money markets and the influence of Fed policy on the short end of the yield curve. And the question is, we seem to see a different slope and a different relationship in the spread between Fed funds rate and the two-year yield curve, two-year yield at present in this tightening cycle from previous tightening cycles. Would you expect, what are the factors underlying that difference, do you think, and would you expect us to repeat the experience, at least in terms of the structure of the short end of the yield curve that we've seen in previous tightening cycles?
Yeah, I think this is the answer to that question has some parallels with the previous question, because there has, of course, been a lot of structural change, not only in the credit market, but there has been structural change in terms of monetary policy. Now, if we look at the very short end of the yield curve, the huge factor is the Fed having put its entire weight onto the shortest maturities that are out there, has literally locked in the short end of the curve with a zero rate policy for the longest, and that of course has meant that the ability of the short end of the curve to reflect normal cyclical fluctuations in the yield curve has been very limited. This is something that has actually led us to shift some of our preferred yield curve analysis further out the curve and focus on for example, the 5 to 30 spread to infer signals that match bond markets with the underlying economy. Now, the answer to the question, should we revisit previous patterns that have played out in the bond market? Well, to the extent that the Fed normalizes its policy, yes, the short end of the curve will become again a functioning signaling device, but it will take some time until we see that normalization. And please keep in mind that our expectation for a Fed normalization is very, very gradual. The Fed will not move very quickly.
Thanks for that, Marcus. We have another very interesting question, again, changing topics, and I think we'll keep it broad, and that question is, what are the best tactical opportunities? There are some suggestions from our audience about what those opportunities might be, and the follow-up to that is now a good time to buy European banks that appear extremely cheap and are arguably better capitalized and are paying in some cases, rich dividends. How do you feel, where do you see tactical opportunities, and if you have a comment on European banks, I'm sure the audience would be interested in that.
Okay, yeah, no, this is This is very interesting because obviously Europe, as David mentioned at the very opening, has underperformed and has actually been beaten up quite heavily during those first weeks of 2016. Now, first of all, in general, we feel that European equities remain very interesting, and here in particular, Eurozone equities. We are actually expressing, as I mentioned in passing at the end, we're expressing our overweight to equities largely through European, and here in particular through Eurozone equities, where we believe that valuation and policy support from the ECB will ultimately play out again and will lead to an outperformance. With respect to European banks, I will mainly focus on what we believe has been maybe a misunderstanding over the past couple of months. There appear to be a view that European banks are on the verge of falling back into a crisis cycle that we have observed back in 2010, 11, and in part in 2012. There were concerns about exposure to the energy sector. There was even in the context of European banks, talk about whether there might be a rerun of the subprime crisis in the banking sector on both sides of the Atlantic. And looking at the numbers, we think that these fears are overdone. Let me just give you one nugget to substantiate that. The exposure of European banks, excuse me, to the energy sector amounts to approximately 3% of the overall loan exposure, or 1.5% of total assets. And of that exposure, the vast majority of exposure is in investment grade credit. So there's very little grounds for fearing sort of a spiral that might evolve, particularly driven by the energy sector. And of course, if you add in the possibility of recovering oil prices, well, then of course a lot of that will be addressed as well.
Let's come back to oil, because there was a question about the paradox of oil price declines being associated with market declines when every macroeconomic model we've ever looked at has a favorable outlook, a favorable impulse from lower oil prices to the global economy and to keeping inflation moderate. Why do you think this time the oil price decline is having such a negative effect on sentiment in the markets?
Well, I think there are probably a couple of reasons, and the one reason we discussed at the opening, we talked about nearly an attempt to find reasons to corroborate a very negative view of the world, and we talked a little bit about the credit implications of lower oil prices. So there could be a behavioral factor that drives that. But I think there's also a very practical reason for that view, and that has to do with the time horizon over which the positive and the negative knock-on effects of lower oil prices are playing out in most economies. Now, if you look at the U.S., for example, there are, of course, winners and losers from lower oil prices. The winners are the consumers who have to pay a lot less at the pump, and the losers is a rapidly growing energy-exposed part of the U.S. economy. We showed the chart about the production increases. Now, what is interesting is that capital expenditures, which are a main vehicle for low oil prices to impact the economy, capital expenditures respond very quickly to lower oil price. And this is what we have seen as literally the initial impact of lower oil prices or playing out last year when U.S. capital expenditures started to come under pressure. At the same time, we did not see consumers benefiting to the same extent. That is something that took more time. So some people called it the J-curve effect of oil prices hitting an economy. You start out with the bad news, and then gradually the good news is starting to work its way in there. So that could be one of the reasons. Generally, we like to remind ourselves that, as you just mentioned, David, that lower oil prices, on balance, are good news, and that the positive impacts for the global economy in particular should outweigh the negative effects of lower oil prices.
I think we have time for one more question, and that one is a shift to geopolitical matters. And the question is, would you agree that the situation in the Middle East is also a factor causing investor angst?
I think it's always very difficult to disentangle the different contributors to investor angst. I do think that any form of uncertainty, any uncertainty will contribute and will play a role in the amount of compensation investors want when they consider investing in risky assets. I'm reluctant to ascribe too much of that to those events that are currently unfolding, because we have clearly measured and we were clearly aware that a lot of the concerns that did drive markets lower were related to headwinds that impacted China, that impacted the U.S. economy, to some concerns about even the European economy. We didn't even touch upon that. So yes, there might have been some impact of geopolitics, but definitely only one factor among many.
Great. Thank you, Marcus and David, for sharing your insights with us. With that, we're going to conclude our webinar today. Thank you to all our listeners for tuning in. Everyone have a great afternoon.